Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Corp and do a stock analysis. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas on potential value stocks to buy or value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, you can leave it in the comments below, and I might do a stock analysis on it. So now let's get into Corp. Now, Corp is basically one of these stocks, as you can see on the chart here, that previously ran up to almost $600. And a lot of people have been thinking it's a good value buy basically for a while. It fell into the 300s, and it's fallen even forward. They're basically under $200. So we're going to basically dive into the analysis, explain why the stock has fallen, is it a value trap, and what might be actually the good value basically going forward basically for it in the future. So let's look at a few of these basically top overline metrics. So one of the things you might have noticed here is in Groove Focus, they have this Groove Focus value band. And right now it's saying it's significantly undervalued. And for predictable stocks, this sometimes can be somewhat accurate. But we're going to see basically if it's accurate as our analysis goes on. You can see right now basically the P ratio sitting at a fair 17.92. And the forward is 17.63. Implying while there is expected to be a little bit of EPS growth going forward in the future, it's expected to be actually be quite minimal from the only relatively lower forward PE compared to the current PE. And you can see they do have a little dividend yield of 2.62% with about a 0.46 payout ratio. And they have provided about, another 2.2% on the, their 3-year average share buyback. So they have been, returning a little bit of capital to shareholders. And they do have a market cap of about $7.1 billion right now. It's not the biggest company in the world. So you can see on a per share basis, the revenue growth basically has been for the last 10 years 12.2% per year. And we can see this represented in this chart here with the green line. But the one thing you'll basically notice, and this kind of gets into looking at a lot of these averages here, is, kind of from 2020 going into 2022, they hit a really huge increase basically in revenue, which has kind of overinflated this revenue trend line a bit. And now they've actually kind of contracted down, and expected growth going forward is expected to be at a much more moderate rate. So right now, basically, the analysts aren't expecting it to continue at this 10% rate. And, we're going to, I guess if they did, that would be, quite good if they actually were able to. And, with basically the average, per share rate of, 12.2%, the EPS growth has been 17.5, meaning they've been able to basically increase their net margin basically over that period of time as well. So that's kind of the things of looking at the past growth trends of, revenue and EPS. You have to see, is it realistic for basically those to continue going forward in the future? Or are we going to have to reprice the company a little bit in a different way? So getting into some of the first metrics here, we can kind of scroll down, look at return on invested capital. And it's actually still sitting not too bad. It's a little bit like lower from off the peaks, from kind of 2014 actually into 2022, but it's close to 16%, which if you actually compare it, for example, 2011 and 2012 and even 2013, it was more in that range. And we kind of know what happened basically right before that. That was the great financial crisis. And if we do look at the chart here, you can see there actually previously the revenue kind of peaked in 2006, 2007, declined, and then it took a little pickup basically again. So it seems kind of Corp is going through not the same, but kind of a similar type of sentiment in that cycle where it got, a lot of growth, and now there's basically some contraction that's basically happening. So I think overall, looking at the return on invested capital where it is right now, that's not too bad considering they've been there in the past, and it's still actually positive, which is good. And getting into the income statement here, you can see basically the revenue, and like I was saying before, kind of you look pre-2020, and it's okay. 2017, almost $2.8 billion in revenue. They had some decent growth, almost $3 billion, but that's still under 10%. And then, it grew to basically 3.2 billion. And then in 2020, this is where the very big jump happens. And because of all the stimulus, more people staying at home, it seems like there was a lot of money basically dumped into, getting, pool supplies, pools made and that. And that's basically cooled off a little bit because, from that, they went to 3.2 billion to almost $4 billion. So that's one of the biggest jumps they had. And then there was even a bigger jump of almost $1.4 billion up to almost 5.3 billion, and then up to 6.2, and then they've contracted a little bit down to 5.5 and 5.3, and a little bit lower basically last year, and now they're starting to re-tick up that revenue a little bit and maybe get more of this normalized trend growing at a little bit slower rate. But I definitely would expect it to be less than 10% because you can certainly see in the pre-2020 years, and when you're a smaller company, it is easier to grow faster. They were growing basically at a slower than 10% rate. But the one really good thing of all of this that I would really like to see is that their gross margin basically has maintained like pretty much for the majority of the time. You can see in 2021 they actually did even actually have a peak of 31. There's like just basically so much demand they were actually able to keep their prices a little bit on the higher side. But even with inflation and all the other issues, it's only come back down to 29.69, which historically is actually a little bit on the higher side. So I do think that's a very strong basically point for them that the revenue is starting to reaccelerate again, as in at least not decline or tick up a little bit, and they are maintaining this very high gross margin. So a lot of you kind of know Pool Corp as basically kind of a monopoly of sorts, basically. And this gross margin maintaining is one indication that they are keeping their monopoly status. And another very good sign is basically the operating margin. Operating margin sitting just under 11% right now. And well, again, in such as times in 2022, it was basically a lot higher. If we look historically, kind of before these two outliers in 2021, 2022, around 11% margin is definitely on the higher side. So even though basically their revenue has come down, and with all the inflationary pressures for basically their overhead and employees, they basically have been able to, on average, over at least the last 10, 15 years, grow their revenue basically more or less at the same or faster pace than they're selling, and general admin is basically growing. So I do think that basically them maintaining at around this 10 to 11% is very good, because again, we swapped any time before 2020, it was basically lower than this, 10.67, 10.47, 10.2, and even lower than that before. So overall, I think their margins are looking really good, and I do think this basically does say they are really maintaining their basically competitive moat, which probably does mean basically good things for them basically going forward, at least for the longevity of the company. The next thing to look at is basically the interest expense, $48 million. This is certainly higher than it basically has been before, but I still think this is well within basically the healthy range. Their operating income is sitting at $585 million, and usually I like to look for about a 1 to 10 ratio, which they are above that. So this is a very comfortable amount of interest expense they had, meaning if they did want to do an acquisition with debt, well, they can certainly afford that if they wanted to. But I think for someone as big as them, they would probably only be looking at smaller acquisitions basically going forward in the future. And we look at basically the bottom line here, net income, basically $400 million after taxes, and that basically, and that's leaving a net margin of just a little bit over 7.6%, which again, we're kind of seeing the same trends with the net margins compared to the operating margins, is that if you kind of exclude this 2020 to 2022 kind of like little anomaly here, this is more basically historically where they've been, and I think is sitting overall as in good place, that they are basically keeping their competitive moat. And what they've been doing with a lot of their capitals, we were talking about share buybacks. You can see basically the shares outstanding have been decreasing over the years, and they are continuing to buy back shares. So this is one of the ways basically returning capital to shareholders. And the good thing is basically they are still making money, and if they are still making money and they can buy back shares when basically the company is a lower price, is one of those things that basically can help stimulate the EPS growth on a per share basis basically going forward in the future. So I think overall, basically the income statement is looking very good and very healthy, and you're not really seeing any major signs of deterioration in the company. All we're really seeing is this abnormal pop in growth and kind of a reversion back to the normal trend. But the real question is when is basically this trend going to normalize? Because if you even look from basically 2019 to basically current day now, which is 6 years, this is still actually quite a bit of growth, 3.2 to $5.4 billion. And if we go back, I guess the similar time, I guess that's in a smaller company, they were still able to grow at about that same percentage. So the question is kind of here is, are we going to see it kind of them decelerate a little bit more basically, and this to kind of be slower growth at this current rate going forward for the next few years before we really see any significant acceleration? That's kind of one of those things we basically don't know. The analysts don't know, but you do kind of have to realize that if you were thinking basically the company is going to be a good value, the revenue basically may not be picking up anytime soon, kind of based on this abnormal growth up and then kind of this reversion in medium. So they could be hovering on more of this, keeping the growth steady, which or not the growth, but the revenue basically flat, which probably in the short term would garner a lower P ratio than basically an 18. And right now, basically, the market is kind of pricing them for some reacceleration and growth again based on that 18 P ratio. We get into the balance sheet. Basically, current assets is sitting just under 2.4 billion. Very little of this is actually cash. It's mostly basically in their inventories here. So that just, what is one thing to keep in mind, that for share buybacks, well, you actually need to sell the inventories to get the cash. You can't just buy back shares with this, $64 million in cash and cash equivalents. And if we do compare that to their total current liabilities, that's only $1.2 billion. So this is a very healthy current ratio. But again, you're going to have to realize this all basically is in inventories. And other interesting thing is we basically kind of, compared from 2020, the current date, and it was kind of after 2020, they really got stocked up on a lot of inventories. So I would say this kind of is, I'm actually going to scroll up and look at one metric that I neglected to basically look at earlier. And it's basically in the inventory turnover here. And you can see basically the inventory turnover basically has kind of been slowing down. And if you look at, the inventory, the revenue, basically that's been effectively going up as well. So, this is indicating that they are sitting a little inventory heavy. So that kind of is one of the, I would say, minor concerns you have to consider, because if they kind of stick, they either have to keep the inventory they have and just kind of, wait for it to sell out. But if they do get stuck with any kind of old inventory that's stagnant, not moving, they basically could be in a situation where they would basically have to discount it to basically get rid of the inventory gluts. And so if we kind of look at basically 2021 and before, when they were doing good, this inventory to revenue ratio was always 0.2 or below. And now we're sitting at 0.27, which is actually significantly higher. So that is kind of just something, to realize with the inventory and the current assets, that even though it says they have, this much inventory on their books and everything, and their current margins are maintaining, it might be that they actually have to lower their prices for that stagnant inventory to basically to get it to move. And as we go a little bit further, basically on their balance sheet here, you can see basically the total assets is sitting at just under $4 billion. And they obviously have done some acquisitions, since there is a little bit of basically goodwill sitting at about $700 million. And when we look at the total liabilities, basically total long-term liabilities, is only 1.6 billion, which is a few lease obligations and mainly a long-term debt, and that's basically where they're paying that for $48 million from. And if you kind of see 48 million compared to $1.2 billion, they do have this all at a pretty basically low rate. And I would assume these are kind of more or less long-term bonds that are kind of locked in at pretty favorable rates. So this is not really debt that I would be too concerned about right now. And overall, the overall amount is pretty low. And that is basically leaving total equity of just over 1.1 billion. But we subtract out the goodwill, we're left with $400 million, which does that really add anything extra to a $7 billion company? I wouldn't say so, because a lot of this basically is sitting in inventory that is kind of sitting a little stagnant basically on their balance sheet, as I previously mentioned. So overall, the balance sheet is overall quite healthy. We kind of already knew basically from the debt situation, from their interest expense was. They are sitting a little bit low on cash, basically, which they have obviously historically done. But they are sitting very high on the basically total inventory. So this is one thing that I would want to basically watch from the quarters going forward, if they're able to get that inventory to revenue ratio to start basically creeping down without compromising their gross margins. That would be a very good sign. Versus if you do kind of start seeing that, the revenue starts popping up a little bit quicker, but their gross margins are basically going down, that kind of would indicate they're just trying to liquidate out some inventory, and is not necessarily the strongest sign for a continuing reacceleration of growth. At least that's how basically I would interpret the changes and what I'm basically seeing on their balance sheet there. When we get to the cash flow statement, and the cash flow statement, there's nothing too exciting going on. You can kind of see the cash flow from depreciation is, very much in line with the purchase of plant, property, and equipment on average. So, that's pretty standard. There's a little bit of stock-based compensation. It's so little, it's hardly basically mentionable. So it's kind of, what you see is, kind of what you get, but they're kind of showing on the, net income statement that is kind of coming down to the bottom line. And as I was saying before on acquisitions, well, they do primarily do these very small acquisitions. You can see only 11 million, 5 million, 12 million. There was a larger one in 2021 for $800 million there. But other than that, these have all been very, very small, basically, acquisitions. And when we look where basically what they're doing with their money, we already know they're buying back shares. We basically have $354 million going to repurchase of stock. And that is quite a bit. And you do need to kind of factor in that right now the net income from basically continuing operations, or basically cash flow from operations, is it's kind of consuming all their basically their cash flows there, because after we look at this repurchase of stock, they also are issuing some dividends at the same time. So they're really going to need to basically get their revenue higher and their net income higher to be able to support this level of repurchases and the cash flow from dividends. And one thing that happens is once basically companies start issuing a certain dividend, and you can see that's how this has happened in the future, they're very, very unlikely to ever cut it. If anything, what's going to happen is they're going to have to scale back on the repurchase of stock, because it sends a really bad sign to the market basically when you cut your dividend. And regardless, they can afford the dividend, but unless they basically start seeing their net income go up, you kind of do have to realize that there is a good chance they're basically going to basically cut the repurchase of shares going forward in the future. Like I said, unless those basically net incomes come up, and we can basically see what's been happening is a total stockholder equity because of that basically has been ticking down. So that is something that could happen. And again, it's one of these unfortunate things when companies do get these big booms, they overextend themselves a little bit and they don't want to cut, because now the stock's fallen basically down a whole bunch, and they may be in a position where they have to start slowing down those basically share buybacks right when they actually want to be purchasing more. And what was happening in 2022 when the stock was at like higher prices? Well, they were buying back a lot of shares at that time, which is pretty typical. But anyways, that's kind of what's happening on the cash flow statement. It's nothing too remarkable. It's mainly, I think, the big takeaway for this is that, again, there is a good chance they may have to slow down this repurchase basically of stock, because, well, unless they can basically get, if we can take this 354, add almost 200 million for dividends there, we need 440, 540 basically $1 million of free cash flow, or on average like net income basically coming in, which it seems like they're still going to be pretty far away from that. So I honestly would expect actually the repurchase of stock to now thinking this out loud basically to slow down basically a little bit in the coming years, which is not going to be good for basically propping up that stock price. And so some of the times the reason stocks run up a lot is, it's going up, but then the company repurchases shares and there's not a lot of people selling at the same time. That really helps basically push the stock price up. So I think a lot of it, Pool Corp, the financials are looking really good. They had this big surge in business and this contraction, and this doesn't have any like big long-term consequences. It's just short-term things of how they're going to manage their money, of what are they going to do basically with this excess inventory. We got to basically weigh that when if they start selling it off at a little bit of a discount, or if that's able to get under just control naturally itself, and if they're going to basically stop their repurchase of shares, not completely stop but slow it down. So I think it really comes down to a valuation question. So we're going to jump into the interactive chart here to start looking at that. We'll just bring up the analyst estimates, even though we kind of already saw them. So you can see the revenue expected to start ticking up quite slowly. This seems honestly like probably pretty reasonable estimates. Like this is under 5% basically revenue growth. And let's bring up the EPS without non-recurring income with estimate. And EPS is expected to pick up at quite a bit faster rate, because as basically the revenue is only expected to grow, like I said, a little bit less than 5%. We'll just maybe call it 4 or 5%. We are expecting from here to there like $1 EPS growth, which is a little bit under 10 and then a little bit under 10 again. So basically this has two implications: that the margins would basically have to continue to increase, and on top of that, not only the margins would have to continue to increase, they're going to have to be buy back shares at the same time. And this is one of these things why when I go into the analysis and I bring up the points I basically did, and I do use analyst estimates basically a lot for some estimations, you kind of have to think how realistic these are. And I think that, okay, the revenue is kind of realistic, but this EPS growth pickup for the previous reasons I mentioned before. One basically is that they're sitting on a lot of excess basically inventory, and even if they don't cut prices basically, and they're not cutting prices on it and slashing and like lowering their margins that way, they're unlikely going to be able to sell it basically at higher prices. So that's one thing that's going to basically keep the EPS from basically going up. And also just from how many dividends they're issuing and stock they're buying back now, It seems like in the coming years, it seems unlikely there would have to be, like I said, cutting the buybacks a little bit. So I kind of don't see how they're going to close this gap of less than 5% revenue growth to, more 8-9% EPS growth, considering those two factors that do look like they could be basically headwinds in the coming next 2 years. So from that, I do think the analysts basically probably are a little bit over optimistic on the short term EPS growth of the company. And now let's look at the other valuation basically metrics here. So we can bring up the price to sales, and this is kind of, a derivative of your margins at the end of the day. And you can see like how expensive it got basically after 2020 into 2021 and 2022, turning at a 4 price to sales when historically it was, kind of really trading more at a 2 and, below. And let's bring up the margins here just so let's see how they work historically. Let's bring up the net margin. And you can see the net margins have gone up, and probably a lot of this increase that did happen basically pre-2020 for the valuation for price to sales did make sense since they were hitting higher net margins of closer to, 7-8%, when previously the peak in 2005 was only 5%. So that definitely does, justify a higher net margin there. But now basically the net margins have come down to about 7.68%. And this realistically, based on everything I was looking at, kind of seems like the new price they basically may stabilize at. So kind of, with that and looking at kind of the relative valuation, well, these prices here, your 2 to 2.5 price to sales ratio in a more aggressive, basically when they're growing well and everything's going well, might be kind of basically more on the high side for them. So, they are sitting at 1.35 price to sales right now, and that is kind of relatively low, but we're also probably going to see a little bit of, slower than expected EPS growth. If we do go historically, there was basically lower margins of almost down to 0.32 during, the 2008 financial crisis there. But other than the price to sales, I think a little bit better kind of look is probably the price to earnings ratio here. And we are sitting like on the lower side, that is around, 17.92. Although, when it was basically went down to 15 temporarily in 2022, and this is the problem with using trailing numbers. It looked really cheap, it bounced up, but now it's basically gone down lower because the revenue is going down, because this was a really big artificial basically surge in price, even though during that time the kind of stock, like the market kind of assumed it would go on forever, and it's actually giving them a higher P ratio, assuming they would continue growing at those levels going forward, which did not happen. So historically before that, kind of on the high side, it was getting close to around a 30 PE, and you can kind of see that, in 2017 here, 2013, 2006, 2005, 2004, that's kind of the upper range PE that I think is kind of realistic for Pool Corp. And that may even be a little bit on the high side because this was when they were smaller and they were able to grow faster. Because during this time, we have to remember too, kind of 2010 going forward, there was a lot of margin expansion happening during that period. Now that there's a bigger company, it seems less likely they're going to be able to keep up that type of margin expansion. But even if there was, you probably would only be looking at basically a 30 PE on the high side. On the low side here, they did get down to, again, sometimes under the 20 PE, down to the 17. Although in 2008, 2009 here, they did get down to basically 11. So, this does kind of show that it's relatively a somewhat attractive PE ratio. But, it could potentially go lower, and we may not actually have basically as a high basically ceiling PEs basically going forward in the future. And if they were to basically, again, miss on kind of like EPS estimates, which I do think is likely, that does create some, temporarily basically selling pressure for the stock, or if the revenue is not growing at a high pace, they can get temporarily re-rated down. And, that actually does create the realistic expectation or, probability that this stock, could actually trade in the 10 to 15 P ratio, kind of at the low side, temporarily at least. And you can see that, actually in 1998 here, they did trade actually under a 10 P ratio and under, around the 12 round here. So, that's not too much of a unrealistic expectation. And if we pop up the dividend yield, I haven't actually looked at this one in advance, and you can see it's getting relatively higher there, showing, but again, we kind of explained the thing is they're paying out between their dividend, their buybacks, they're kind of paying out more than they probably should be. So I wouldn't say this is the best metric for determining basically if this is a good buy right now. So the next thing we're going to do is we're going to go into my kind of discounted earnings estimate calculator. And I basically took the estimates from their, well, I think I just made up my own based on their, kind of current trajectory they were putting at, which I think is on the aggressive side, like I was saying, 15, because in I was thinking basically they were saying, oh, it's going to go like 11, 12, 13. So I said, okay, let's just, dollar. And this is probably above what it, would actually achieve. But by end of 2030, basically a 15 PE. And you can kind of see that at the current stock price, if you were to hit kind of a 20 PE, that would give you a 13.4% compound annual growth price if you were to buy it now. And if you're hit on the high side, it would be 24. But if we lower these numbers a little bit, because let's basically actually take off this and basically look at the EPS with estimate here. And if you were to basically say, oh, we're 11 right now, and we're going to grow at, a little bit, lower rate, more, let's just see here. I'm just going to make up basically some numbers myself in the background here. Just a second. So, say it gets to, $13 instead, you can kind of see, and especially, at a lower PE, this definitely starts becoming a lot less basically attractive of a stock price at that time. Now, if we do look at the chart here for kind of the technical analysis, is there wasn't the 200-month moving average going further back, but in 2008, 2009, this was the relative low, and that's where we are now. So could be an attractive basically time to buy it, but you also kind of have to realize if you did buy it back here, for example, at $17 in November 2008, it almost did go sideways basically until 2010, and that kind of does seem like a probabilistic outcome that it kind of can bounce around for a little bit, where kind of it finds its footing and kind of goes sideways into the valuation before really taking off. And I think that probably would looking at the time factor rather than like a lower price is probably kind of how to look at pool stocks. So it's like if you are kind of wanting to buy it at looking to buy it, it's you kind of wait for the dips for it. I don't really see any catalyst that it's going to take off and be able to grow very quickly, since even if we kind of use these high estimates, these are not the most attractive optimistic things, because even though you say, oh, 24%, it's like, well, I'm using a very, very high P ratio and, kind of a much higher, basically, EPS growth. And if we were, to have lower numbers than this, the numbers basically start becoming a lot less attractive, which, would happen basically on any EPS misses. So anyways, Pool Corp is a stock that, I'm interested in. I'm kind of like, just more waiting to see what it does, wait a little bit, probably more for like a little bit of a bottoming process. But like, if you're looking from, I think, a very, very long-term perspective, it's probably like, could be just a fine stock to buy now. You're at least going to basically get the dividend. And, if you're going to be holding it for like 10 years, in 10 years time, there basically is the very high probability, in my opinion, that they kind of resume back to the normal trend, kind of get somewhere around this middle trend line here, which kind of seems to be normal. And well, 2026 here, going out to 2030, that's potentially quite a big, increase in the share value there. So anyways, that's my analysis on Pool Corporation and my thoughts on the stock. I hope you liked it. Make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis.